Welcome back to the channel, and if this is your first time here, make sure you hit that subscribe button and turn on notifications because we're covering the most critical gold and silver updates every single day. Today is February 14th, 2026, and we're witnessing a massive shift in Federal Reserve policy expectations that's sending shockwaves through the precious metals market. Let me break down exactly what's happening and why this matters for your investment portfolio. So let's start with the headline number. Gold is trading above $5,070 per ounce as of this morning. That's near a 2-week high, and the metal has staged an impressive recovery from the brutal sell-off we saw at the end of January. Silver is sitting around $82 per ounce, also bouncing back strongly from the lows. But here's what most mainstream financial media is completely missing. This isn't just a technical bounce. This is the market repricing precious metals based on a fundamental shift in monetary policy expectations. 1 week ago, the consensus view was that the Federal Reserve would cut interest rates twice in 2026. That was the baseline assumption. Traders, investors, and analysts were all positioned for 2 quarter-point cuts, probably in the second half of the year. But in the last 7 days, everything changed. Fresh economic data came pouring out, and every single report pointed in the same direction. The U.S. economy is weakening faster than anyone expected. And now, as of today, markets are pricing in 3 full rate cuts for this year. That's a 50% increase in expected monetary easing in just 1 week. Why does this matter so much for gold and silver? Let me explain the mechanics, because this is crucial to understand. Gold and silver are non-yielding assets, meaning they don't pay interest or dividends. When interest rates are high, investors can earn attractive returns from bonds and savings accounts, which makes precious metals less appealing by comparison. But when the Federal Reserve cuts rates, those bond yields and savings rates come down. Suddenly, the opportunity cost of holding gold and silver decreases dramatically. There's less incentive to keep your money in cash or bonds when they're barely paying anything. But it goes even deeper than that. Rate cuts are a signal that the economy needs help. The Federal Reserve doesn't cut rates because everything is going great. They cut rates to stimulate growth, to prevent recession, to keep the economy from falling off a cliff. And when investors see the Fed preparing to cut rates aggressively, they start asking themselves, what does the Fed know that we don't? What are they seeing in the economic data that's making them worried? That fear and uncertainty drives investors straight into safe haven assets like gold and silver. Now let's talk about the economic data that triggered this massive repricing. December retail sales came in completely flat, missing all analyst forecasts. Retail sales are one of the most important indicators of consumer health because consumer spending makes up about 70% of the U.S. economy. When Americans stop spending, the economy contracts. The fact that retail sales stalled in December, which includes the holiday shopping season, is a major red flag. This wasn't supposed to happen. Economists were expecting growth, and instead we got zero. The GDP control group, which is a key input for GDP calculations, slipped 0.1%. That's a contraction. Job openings, measured by the JOLTS report, fell to their lowest level since 2020. Think about what that means. We're back to pandemic-era levels of job openings. Companies aren't hiring. They're not expanding. They're getting cautious and defensive. Private payroll growth from ADP undershot expectations significantly, showing that the labor market is cooling faster than anticipated. All of these data points, when you put them together, paint a picture of an economy that's losing momentum. The soft landing narrative that everyone was celebrating just a few months ago is starting to look questionable, and the bond market is already responding. Treasury yields have been falling as traders price in more rate cuts and slower economic growth. When yields fall, gold becomes more attractive, and that's exactly what we're seeing play out in real time. Let's dig into what 3 rate cuts actually means for the economy and for precious metals. Each rate cut is typically 25 basis points, or 0.25%. 3 cuts would bring the federal funds rate down by 75 basis points total. Now, the current rate is in the range of 4.25 to 4.5%, so 3 cuts would bring us down to around 3.5 to 3.75% by the end of the year. That's still not low by historical standards, but it's a significant move in the direction of easier monetary policy. But here's where it gets really interesting. Some analysts are already saying that 3 cuts might not be enough. If economic data continues to deteriorate at the current pace, the Fed might need to be even more aggressive. We could be looking at 4, 5, or even 6 rate cuts over the next 12 to 18 months. Why? Because once you start cutting, it's hard to stop if the economy doesn't respond. The Fed gets caught in a cycle where each cut is supposed to jumpstart growth, but if growth doesn't materialize, they have to cut again. This creates what's called a dovish spiral, where the central bank keeps easing, and each round of easing makes investors more worried about the underlying health of the economy. It's a catch-22 situation. The Fed cuts to help the economy, but the cuts themselves signal weakness, which makes investors nervous, which can actually make economic conditions worse. And in that environment, gold absolutely thrives. Historical data backs this up completely. Go back and look at every major rate-cutting cycle in the last 50 years. Gold performs exceptionally well when the Fed is cutting rates aggressively. The 2001 to 2003 rate-cutting cycle saw gold rally from $260 to over $400. The 2007 to 2008 financial crisis rate cuts sent gold from $600 to over $1,900 by 2011. The pattern is clear and consistent. Aggressive Fed easing equals higher gold prices. Now, some people might argue that the Fed cutting rates is actually bearish for gold because it means they're successfully managing the economy and preventing recession. But that's a misunderstanding of market dynamics. Gold doesn't rally because the economy is doing well. Gold rallies because investors lose confidence in fiat currency and government debt. When the Fed is cutting rates, printing money, and expanding their balance sheet, they're debasing the currency. They're creating more dollars, which makes each individual dollar worth less. Gold, which has a fixed supply, becomes more valuable in dollar terms simply because dollars become less scarce. Let's talk about what's happening in the Treasury market, because this is critically important and not enough people are paying attention to it. The yield curve, which had been inverted for almost 2 years, is starting to normalize. An inverted yield curve, where short-term rates are higher than long-term rates, is one of the most reliable recession indicators we have. It's predicted almost every recession in modern history. The fact that the curve is uninverting now suggests that the recession many economists have been predicting might finally be arriving. Treasury yields across the board have been falling. The 10-year yield has dropped from around 4.7% at the peak to now trading closer to 4.3%. The 2-year yield has fallen even more dramatically because that's the maturity most sensitive to Fed policy expectations. When traders expect rate cuts, they buy bonds, which pushes yields down. This is happening in real time, and it's creating a very favorable environment for gold and silver. At the same time, we're seeing interesting dynamics in the dollar. The US dollar index, which measures the dollar's strength against a basket of major currencies, has been relatively stable but showing signs of weakness. It had rebounded from 4-year lows after Kevin Warsh was nominated as the next Fed chair. But that strength is fading. Why? Because if the Fed is going to cut rates 3 times while other central banks like the European Central Bank might be done cutting or even considering rate hikes, that interest rate differential makes the dollar less attractive to hold. A weaker dollar is typically bullish for gold because gold is priced in dollars globally. When the dollar falls, gold becomes cheaper for foreign buyers, which increases demand. Also, many investors view gold as an alternative to the dollar, so dollar weakness often coincides with gold strength. We saw this pattern play out dramatically in the bull run that took gold from below $2,000 to over $5,500 in just about a year. The geopolitical backdrop is also supporting precious metals right now. Tensions between the United States and Iran continue to escalate despite some tentative diplomatic discussions. The U.S. has issued warnings to American-flagged vessels to avoid Iranian waters. Any military conflict in the Middle East could instantly disrupt oil supplies and send energy prices soaring, which would be highly inflationary and very bullish for gold. Let me talk about silver specifically because silver is showing some very interesting price action that differs from gold. Silver closed above $82 per ounce today, which represents a nearly 2% gain. That might not sound like much compared to the volatility we've seen recently, but it's significant because silver is holding above a critical technical support level. The key level that technical analysts are watching is $81.85. This is the 38.2% Fibonacci retracement from the recent rally. For those of you who aren't familiar with Fibonacci retracements, they're a technical analysis tool based on the idea that markets often retrace a predictable portion of a move before continuing in the original direction. The most important retracement levels are 23.6%, 38.2%, 50%, and 61.8%. When a market pulls back to the 38.2% level and holds, that's generally considered a healthy correction in an ongoing uptrend. Silver tested this level and bounced, which is a bullish sign. But silver's story is different from gold's because silver has such a large industrial component to its demand. More than 50% of silver demand comes from industrial uses. We're talking electronics, solar panels, medical equipment, automotive applications, and increasingly, data centers for artificial intelligence. The AI boom is creating enormous demand for silver because data centers require massive amounts of electrical infrastructure, and silver is the most conductive metal on Earth. Recent data shows that AI-related data center construction is accelerating even faster than expected. Major tech companies are in an arms race to build computing capacity for AI applications. Microsoft, Google, Amazon, Meta, they're all spending tens of billions of dollars on data center infrastructure. Each of these facilities requires significant amounts of silver for electrical components, circuit boards, and thermal management systems. This demand is structural and growing, which creates a floor under silver prices. The solar industry is another massive driver of silver demand. Despite some concerns about overcapacity in solar panel manufacturing, particularly in China, the global transition to renewable energy continues to accelerate. The Silver Institute estimates that solar panel production consumes between 10,000 and 14,000 tons of silver annually, representing up to 41% of global annual supply. That's an enormous percentage of total production going to just one industry. And here's the critical issue. Silver mine production is only expected to increase by about 1% in 2026 to approximately 820 million ounces. Meanwhile, total silver demand is projected to exceed 1 billion ounces. That gap between supply and demand has to be filled somehow, and it's being filled by drawing down above-ground inventories. But those inventories aren't infinite. The silver market has now been in deficit for 6 consecutive years according to the Silver Institute. 6 years of consuming more silver than we're producing. Eventually, those stockpiles run out, and when they do, the price has to adjust higher to either incentivize more mining production or reduce demand. The problem is that most silver comes as a byproduct of other mining operations, particularly copper, lead, and zinc mines. You can't just turn on more silver production easily. It takes years to develop new mines, and most of the easy-to-access silver deposits have already been mined. This creates a very bullish long-term outlook for silver prices. Now let's address the elephant in the room, the volatility. Silver experienced one of the most violent price swings in history just 2 weeks ago, crashing from $121 to $71 in a matter of days. That's a 40% decline in less than a week. Many investors got completely wiped out if they were using leverage. The futures market saw forced liquidations as the CME Group raised margin requirements from 11% to 15%. Traders who couldn't meet the higher margin calls were forced to sell, which created a cascading effect. But here's what you need to understand about that crash. It was primarily a leverage flush in the paper futures market. The physical silver market remained tight throughout the entire episode. Coin dealers couldn't keep inventory in stock. Premiums over spot price remained elevated. Industrial buyers were scrambling to secure supply. The disconnect between paper price and physical reality was stark and obvious to anyone paying attention. U.S. Treasury Secretary Scott Bessent tried to explain away the volatility by blaming Chinese traders and calling it a speculative blow-off. But that narrative doesn't hold up under scrutiny. If it was just speculation, why did physical demand remain so strong? Why did China's central bank continue buying gold through the entire correction? Why are premiums still high? The truth is that there's genuine fundamental demand supporting these higher price levels, even if the path getting there has been volatile. Looking ahead, what can we expect for the rest of February and into March? The key events to watch are the upcoming U.S. jobs report and inflation data. The January jobs report has been delayed but should be released soon, and it could be a major market mover. If the jobs report shows significant weakness, it would confirm the trend we're seeing in other economic data and likely push Fed rate cut expectations even higher. Markets could start pricing in 4 cuts instead of 3. Inflation data is equally important because the Fed has repeatedly said that they need to see inflation moving sustainably toward their 2% target before they'll cut rates. January CPI and PPI numbers will give us insight into whether inflation is continuing to cool or potentially reaccelerating. If inflation comes in hotter than expected, it complicates the Fed's ability to cut rates even if the economy is weakening. That scenario, where we have weak growth and rising inflation simultaneously, is called stagflation, and it's one of the most bullish possible environments for gold. The major investment banks have been updating their precious metals forecasts, and the revisions are telling. JPMorgan maintains their year-end 2026 gold target of $6,300 per ounce. That implies another 25% upside from current levels. Goldman Sachs has gold at $5,400 by December. Bank of America is even more aggressive with a $6,000 target. These aren't fringe analysts making wild predictions. These are the largest, most conservative banks on Wall Street telling clients that gold has significant upside. For silver, the forecasts vary more widely because of the higher volatility and industrial demand component. UBS thinks silver could bounce back to $100 in the near term, but then settle around $85 by year-end. Macquarie raised their 2026 average silver forecast to $62. The Silver Institute is more bullish, suggesting that the supply deficit will push prices considerably higher over time. My personal view, based on the fundamental supply-demand picture, is that silver has more percentage upside potential than gold, but it will also be more volatile along the way. What should you be doing with this information? First, understand that we're in the early innings of a major precious metals bull market that started in 2020 and likely has years left to run. The fundamentals supporting higher gold and silver prices, massive government debt, central bank money printing, de-dollarization, geopolitical instability, supply deficits. These factors aren't going away. They're getting worse. This isn't a short-term trade. This is a long-term strategic position. Second, use volatility to your advantage. The crash we saw in late January presented an incredible buying opportunity for those who understood what was happening and didn't panic. Gold went from $5,600 to $4,400, and now it's back above $5,000. Silver went from 121 to 71, and now it's back above 82. If you bought during the panic, you're already sitting on substantial gains. The lesson is that corrections in bull markets are opportunities, not disasters. Third, focus on physical ownership when possible. The divergence between paper markets and physical markets that we witnessed during the crash was eye-opening. Paper silver collapsed while physical silver remained difficult to source. In a real crisis scenario, will your paper claim to gold or silver be honored? Do you actually have possession of the metal? These are important questions to consider. Whether it's coins, bars, or allocated storage at a reputable vault, physical metal gives you true ownership. Fourth, be prepared for more volatility. The Fed cutting rates aggressively is not going to be a smooth, calm process. There will be market turbulence, political pressure, confusing economic data, and probably more attempts by the financial establishment to shake out weak hands from precious metals positions. If you're going to invest in this sector, you need the emotional fortitude to withstand 20, 30, even 40% drawdowns without panicking.
The bottom line is this. Gold above $5,070 today with Fed rate cut expectations tripling is not a random occurrence. It's the market telling you that monetary policy is about to get much easier. Economic growth is slowing, and fiat currency is being debased at an accelerating rate. Gold and silver are responding exactly as they should to these conditions. The trend is clear, the fundamentals are strong, and the setup for higher prices in the months and years ahead looks extremely compelling. That's your complete update for February 14th, 2026. Make sure you like this video if you found it valuable, subscribe to the channel for daily precious metals updates, and drop a comment telling me your price targets for gold and silver by the end of this year. Are we going to 6,300 like JPMorgan says, or even higher? Let me know what you think. I'll see you in the next video.